Hello, non-eye cappers. Thank you guys for joining us once again on this beautiful, beautiful podcast that we're creating. Don't forget to subscribe to the channel. Don't forget to go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@nineeyecapitalgroup.com. Send us your questions, or you can go to the website at www.nineeyecapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. And today we're here to educate not only the advisor, but we're here to educate the end client as well. Are you paying too much for your advisor? And how would you know if you were? This is an industry debate. It's time to break it down. Let's get it. Now, before we dive in head first, let's talk about why understanding how your financial advisor gets paid is very, very important. Knowing how your advisor earns their compensation is crucial because there's a lot of, ambiguity in what a financial advisor actually does. And we're going to get into that in this podcast today, but we're going to start with just understanding conflicts of interest. So, conflicts of interest. What are they? Why is it important to understand that? And how to mitigate those conflicts of interest. Now, I'm talking to both advisors. I'm talking to the end client right now because it's very, very important to have this conversation. So, first and foremost, conflicts of interest in the advisory world refer to situations where the interests of the financial advisor may diverge from the best interests of the client. These conflicts can arise due to advisors' potential to benefit financially from certain recommendations or actions they take on behalf of their clients. Conflicts of interest can manifest in various ways, including compensation structures, basically how they get paid, whether it be through a managed money relationship or what have you, commissions, whatever. Second, product sales. Are they going to sell you some life insurance? Are they going to sell you some annuities? Are they going to sell you just strictly products and move on their merry way? Third, cross-selling. Well, you know what? Hey, if you buy this, we're going to get you in this. When some advisors are incentivized to cross-sell you. Like, for example, we had the Wells Fargo's issue, right? They were cross-selling their individuals. They were basically selling them these types of accounts and then selling them, opening up business accounts because they were getting compensated to do those. There's opportunities there where people can give you different ideas and different structures to basically advise you to go a different direction that you may not need to be going. So it's cross-selling. Next, referral fees. Referral fees is very, very big because now, guess what? If you have a referral and I get paid for that referral, you need to know exactly why are you sending me to this individual? Why are you sending me to this individual based on the relationship? Are you getting compensated for that? Disclosure is very, very important. And finally, if you have a personal relationship with someone, you got to know that. You got to know exactly what that relationship looks like, because if it's a personal relationship, that's a conflict of interest. You have to disclose these things. All these things we just discussed need to be disclosed while having this conversation. So we're talking about conflicts of interest and how they can erode the trust of the advisors and the clients and undermine the integrity of the advisory relationship. This needs to be mitigated. Conflicts need to be mitigated. Advisors should prioritize transparency and potential conflicts of interest and make sure that it's all disclosed. So when you're having conversations with a financial advisor, make sure you're having this conversation. Hey, how are you compensated? Hey, why are you referring me out to said trust individual for estate planning? Hey, why are we using this CPA? Traditionally, they did give you more opportunities to to make your own best decision, maybe give you three or more individuals to basically go in and say, okay, let me look at these three individuals and see which one's best for me. So conflicts of interest is very, very important. So we've gotten past conflicts of interest right now. Now let's talk about the types of advisors that are out there. If you go on LinkedIn, Twitter, whatever type of social media you'll see advisors just battling back and forth about Oh, we're better than you. We're commission based because we don't have any dog in the fight, and we're basically going to get paid a commission because we're giving the client what they need. You're going to have a fee-based advisor saying, well, we're fee-based when we could do both commissions and fees, and we're in the best interest of the client because that's what it states in the state constitution, and that's where we come in because we're better than you. And finally, you have the fee-only advisor that comes in and says, you know what? I don't operate in the commission world, so I have no conflict of interest there. And we are here strictly for the best interest of the client because we stand above and beyond and alone in our integrity in the business. Well, that's fine, but they all have conflicts of interest. They all have their own interest in mind because you know why? The commission-based advisor has an interest to sell you a product. The fee-based advisor may have an interest in not only selling you products, but also giving you an advisory accounts to charge fees on that. And of course, the fee-only advisor may have an interest just to strictly charge you for assets under management or basically get you into a plan. So it just depends on what you're looking for as a client. So let's start with the commission-based advisor. So what is a commission-based advisor and what does it actually mean? A commission-based advisor earns their income by selling products like mutual funds, insurance policies, annuities. They receive compensation or a percentage of the sale from those products. Are there downsides to this risk compensation model? Well, of course. One potential conflict would be that they're going to put you into something that pays them a higher commission. They're going to get you into an annuity or a life insurance product or something like that to that effect. And if you buy more of it, that's more money they make. So it's not necessarily a bad thing, but that's something to look out for. And it may not be in the best interest of the client. So when is a commission-based advisor appropriate? Commission-based advisors can be suitable for individuals who are looking for a one-time transaction for a specific product. For example, hey, Mr. and Mrs. Client, Mr. and Mr. Advisor, I need $500,000 of life insurance. Can you get that to me? Perfect. Boom, go get it. A commission-based advisor may be good in that role. Hey, you know what? I need to roll over $50,000 and I just want to put it into a low-cost A-share, whatever what have you. And that's all I'm looking for. I don't want anything else. Can you do that for me? Yes. Or I'm looking for an annuity. Can you do that for me? Yes. So a commission-based advisor does work well in that landscape. But here's the caveat. If you're looking for long-term advice, that may not be the best opportunity for you. Why is that? Because once they get paid, they may no longer do business with you moving forward because there's no compensation to justify the additional service from what they've been paid up front. So that's a commission-based advisor. Let's get to the common fee-based advisor that operates with both hats. They have that hat on the investment advisory fiduciary world and their hat in the space of commission-based products and services as well. One benefit is the potential alignment of interest between the advisor and the client. Since the advisor receives fees for their advice, they may only be inclined to act in the client's best interest. Now, we're going to get to the client's best interest here in a moment because that's a vague term. Additionally, fee-based advisors often offer a more transparent fee structure, making it easier for clients to understand what they're paying for. So, when might someone consider working with a fee-based advisor? Fee-based advisors are well suited for individuals who require ongoing financial planning and investment management services. This model provides a comprehensive approach to financial advice with flexibility to adapt to clients' ever-evolving needs. Beautiful, beautiful take. And the reason why it's a beautiful take is because not only can they serve you on the investment advisory role as a fiduciary, they can also serve you on the, hey, Kevin, I need to see if we can get something for this for our kids. I need to get a such and such, or a life insurance policy, or this, that, and the other. Can you knock that out for us? Absolutely. So those are the concepts here, whether it be an annuity or life insurance and acting on both sides of the fence. It may work out in the best interest of the client. Now, again, the downside of this is that they may operate in a world that's best for them. There's no way to get rid of conflicts of interest. There's just no way to do it because you know why? Because there's always an interest to another individual. For example, in the fee-based world, there may be an opportunity for them to say, you know what, I'm going to put all this money into money management and just get my fees. Or, you know what, I can put money over here, but I can get this annuity compensation over here as well. So it's important to understand what kind of advisor you have and how they're acting in your interest. Lastly, let's discuss the fee-only advisors, how they differ from previous models. So fee-only advisors solely charge fees for their services and do not earn commissions from the products they sell. This model aims to minimize conflicts of interest and prioritize the client's best interests. But do they? Again, I'm in this world as well. I'm in the fee. I'm in this world, but I understand that. Is it true that you have no conflicts of interest or you minimize the conflicts of interest? And the answer is absolutely not. Because now my incentive is to basically do what? Gather as much money as I possibly can to put money into AUM or charge the client as high a fee as possible up front to make sure we can keep the lights on. Now, I'm not saying that that's a bad business model. They're not providing value for the payment. That's not what I'm saying. But there's always a conflict of interest. So what are some of the advantages of working with the fee-only advisor? One major advantage is the reduced conflicts of interest. Since fee-only advisors don't earn commissions from product sales, they're not likely to be influenced by outside incentives when making recommendations. Additionally, fee-only advisors are often held to a fiduciary standard, meaning they're obligated to act in the client's best interest at all times. Hold up. We're going to get to this best interest thing here in a second, but let's just finish this right here. So, in what situations might a fee-only advisor be a preferred choice? Fee-only advisors excel in providing comprehensive financial planning and wealth management services, especially for high net worth individuals. Their focus on holistic financial planning can help clients achieve their long-term goals. Absolutely. But guess what? So can a fee-based advisor. So can a commission-based advisor. There's no advisor that's the ultimate choice in this solution. It's all about what is best for you, the end client. Again, I operate in these worlds. Fee only, I get it. Fee-based, I get it. Commission, I understand that as well. I came from the commission-based world on the insurance side from a large insurance company. And trust me, I get it. This is the reason why I'm on this side of the fence right now, because I don't like that world. But I'm not saying it's the wrong thing to do. I just don't like the commission-based world. But that's not the wrong place to be. It's good for people, but it wasn't good for me. So to end this, I want to talk about this vague term because it's very vague. And it's all about the DOL and prohibited transaction rules and all this stuff from the regulatory bodies that are trying to do a couple of different things. They're trying to levelize compensation across the entire industry, which I don't know how they're going to do that. How can you tell me that a person in California needs to make the same amount that a person in Kansas is making? Two different lifestyles, two different cost of livings, just two different places. So it doesn't work. So best interest, what is it? Best interest refers to the legal and ethical obligation of financial advisors to act in the utmost benefit of their clients when providing financial advice or managing investments. Acting in the client's best interest means prioritizing the financial well-being above all considerations, including the advisor's own interest or the interest of any third party. Now, the question that as a client you're asking yourself is, well, hasn't that always been the case? And the answer is no. Because I've been in the world on the commission side where if someone's rolling over $100 million, the first thing is going to be, I don't care about your financial plan. We're going to figure out how we can basically divvy this money up into different products. And then maybe it's going to be a 3.5% load on $200,000. Maybe it's a 6% payout on an annuity at $500,000. So think about that. If they can cut that up to where it's $300,000, say if it's $300,000 into $500,000 into an annuity at 6%, that's $30,000 of compensation to the broker dealer. Now you take another $200,000 into some other product, and now into an investment product, that's another 3%, maybe a 3% loss, another $15,000. So it's $30,000 on the first 500, another $15,000 on the 200. Now you got another $400,000. What are they going to do with it? Oh, maybe we can do some life insurance stuff. And they're getting another 75 to a 93% payout at the agency on the life insurance premiums. And they may throw another $30,000 a year into a life insurance policy. Whoa. So you can see how all that money gets chopped up and paid out to certain individuals, whether it be an agency, whether it be an advisor, or whether it be a broker dealer. It's a very lucrative business. Now, let's talk about the key aspects of the client's best interest and what it includes. One, the fiduciary duty. Financial advisors who are held to a fiduciary standard are legally obligated to act in the client's best interest. Two, disclosures. Advisors must provide full and transparent disclosure of potential conflicts of interest that could influence their advice. Third, suitability. Now, suitability has been one of those terms in the past that has been very, very loose. Is it a suitable investment? Hey, checkbox. Put $1 million over here into this life insurance policy. Ridiculous. Recommendations made by advisors must be suitable for the client's financial situations, goals, risk tolerance, and other relevant factors. This ensures that advice is tailored to meet the specific needs and circumstances of each client. Lastly, continuous monitoring. This is where it's key, because like I said before, the commission-based structure doesn't do, or they say they do, they may not do it in a very good way. Advisors should continuously monitor their client's financial situation and adjust their recommendations as necessary to ensure they remain in the client's best interest over time. So if that's important, that's acting in the client's best interest. That is the best interest contract that we are engaging in on the fiduciary side of the fence, which is where we operate in at 99 Capital Group. So let's just break this down in conclusion. One, are you paying too much for your advisor? Are you paying too much for your advisor? Well, I'm going to tell you this. I don't believe anyone's paying too much or too little for their advisor. You're paying whatever the market rate says it says it is. I don't necessarily suggest they levelize compensation because it's not for them to do. This is a capitalist society, and whatever someone is willing to pay or do is subject to market rates. Now, the question you have to ask yourself as a client, as an end consumer is, am I getting the level of service for what I'm paying? Because that's how you value cost. Cost is not the $1,000 or $2,000 that you're paying. Cost is what you're receiving. What am I getting? Like if I have my iPhone and it may have cost what I've given it, what I've put out $1,000 or what have you. But the reality is what you're getting in return goes far beyond that. So this is basically a free phone. This could cost me anything. So the question you have to ask yourself, are you getting what you're paying for? Because that's the true cost. So let's break this down for the last piece of this podcast today. Are you getting the level of service on the fee side on what you're paying, especially in the fee world? Are you getting comprehensive financial planning? Is that even what you want? Because a lot of times we have this conversation about, well, we do all these different things, but your client may not even want that. First, find out what it is that your client wants, and then give them what they're asking for. Is it comprehensive financial planning? Is it tax planning? Is it estate planning? Is it debt and cash flow management? Is it investment management? Is it whatever else you're trying to provide? Property and casualty, whatever it is. Insurance, risk management. if you're providing all these different things, and I'm going to say one thing, your cost is probably way too low. But the reality is we charge based on what the client is asking for: investment management, tax planning, estate planning, comprehensive financial planning, debt and cash flow management. All these things we provide for our clients, and ongoing services on an annual basis. And guess what? Meetings, however many you want, however many you need. Because you know what? Just because I meet with you once a year doesn't mean your life doesn't change more than once a year. It's all about the value that you're providing, and the ability to do what? To get back to your client as soon as humanly feasible. Clients love that. People, that's what you deserve as a client. That's what you would want as a client. That's how I operate my business. I operate my business as how I'm expected to be treated when I call someone. I don't expect to be, we'll get back to you within 24 to 48 hours. That is unacceptable. Unacceptable. And that's not a good way to be treated, especially when they're dealing with your money. Thank you guys for joining the 980s podcast. Today we talked about fees. We talked about, are you paying too much? We talked about what's the value you should be receiving. We're talking in all different avenues today. We're talking to the client. We're talking to the advisor, because it's very, very important, because this is the industry debate that everyone's having about, are you getting what you're paying for? And if you're not getting what you're paying for, you can always contact the market to get what you want. Thank you guys for joining us. As we always say, subscribe to the channel. As we always say, go and get my book, Get My B to CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. Go to the website at www.9icapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. I'm here to empower you to go find that advisor that you're looking for, or you can call us. Of course, we would love to help you as well. Thank you guys so much. Unite iCappers. Stay humble, stay safe. We'll see you again soon.